Hello and welcome again to all our investor clients across Australia and overseas. Here we are at the end of the first quarter of 2018. There's military action in Syria, the global stock markets are all dancing to different tunes. The US is dancing to its own drum with a heavy reliance on tech stocks and good signs of continuing growth. China is under pressure to move from industrial to technology, and the resource countries like Australia are not quite sure what may be in store with the talk of lower commodity prices for copper and iron ore. Also on the political front, we witnessed the impact of the Labor announcement and the possible demise of dividend imputation. If we take dividends out of the Australian share market index, then we've not witnessed any growth for the last 10 years. Chris Watling, our global economist, will give us his view on the economy and the key drivers for growth for the next month. This will reflect changes that we will make to our growth portfolios and in particular our conservative investors' search for better yields. Over to you, Chris, in London.
Clearly it's been an interesting month. Markets and investors slightly unnerved. A number of 1% moves that we've seen in the S&P over the course of the last month has been pretty high, whether it's up or down days in the S&P, and this, as I say, is unnerving investors. And of course it's not surprising when you compare that kind of volatility to what we had over the course of 2017. In fact, over the last month, in the US stock market, the main stock market, the S&P 500, we've had more 1% up or down days in that past month than we had over the course of 2017 in its entirety. So investors are unnerved, but it's worth remembering that this is normal. 2017 was abnormal. This is far more normal behavior from markets and really shouldn't be unnerving at all. And in fact, we should be encouraged technically. So whilst it's choppy, but technically it's holding key support levels. People look at the 200-day moving average as a key support level, and the S&P 500 is doing a very good job of holding that level. However, for medium-term investors, these are sort of small issues. What really matters is the direction of travel of equity markets, and indeed, are we still in a cyclical bull market, or should we be starting to get more nervous? And our conclusion is clear. If we look at the fundamentals, the macro, the earnings, and the liquidity picture in the States and across the globe, indeed it's pretty good. In fact, the US economy, I think, is in good shape, notwithstanding our key global economic theme, which is the slowdown we see in the industrial sector of China and the Eurozone and indeed across the globe. Notwithstanding that and the softening of growth we expect in China and the Eurozone as a result, the global economy is now being driven, we think, by the US. The US is the key driver of global growth at this junction, and therefore we'll continue to see good economic growth globally and good earnings growth as a result of that out of the States. Indeed, the US earnings season has just begun. And in fact, we've seen just today some very good results from some of the bigger banks. And we expect it to be a very positive earnings season with double-digit earnings growth underpinning the stock market and helping drive it forward. So the macro's good, the earnings good, and the liquidity's good, despite a bit of concerns out there about things like TED spreads, LIBOR OIS spreads, and so on and so forth. There's a little bit of concern about some cracks in the liquidity landscape. I would say overall, if we look at our models, liquidity is plentiful. The money creation system is working well. If you look at high yield corporate bond spreads in the States, they've been tightening over the last week. That's encouraging, and they're at low levels. So all three key main drivers of markets are in place. The cyclical bull market's alive and well. And we like the US because of its tech-heavy nature. On that fact, as I said, one of the key themes in the global economy is the switch from synchronized global growth to US driving global growth. And one of the key underpinnings of that is the weakness in the industrial sector and the industrial cycle that we're seeing come through in China and knock-on effects into the Eurozone. Now, I think that's key for Australian investors because I think there are implications for commodity prices from that. We've seen copper trading sideways since August last year, iron ore pretty much the same sort of pattern. And I think if China really does slow on the industrial side and the Eurozone as well, we'll see those commodity prices move lower. So impacts on the Aussie dollar as a result, favouring overseas equity investments over domestic Australian equity investments. We like the US, as I said, we like technology, and the bull market is alive and well. So best wishes for the next month. We'll touch base in a month's time. Thanks very much.